The third speaker today is Martin Hellwig, and he will be joining us with his presentation or his comments. So, Martin?
Well, thank you very much. Can you hear me?
Yeah, very well, thank you.
Thank you. Thank you very much. I do not have a presentation, but just words. Before going to my own content, two small notes about the oldest central bank with independence was the Swiss central bank, and the one where it's most strongly entrenched, and largely because the politicians knew that they didn't understand anything about it. A second note on history, the 1970s, 80s discussion about trade-offs between inflation and unemployment and time consistency was much later than the 1922, 1923 German and Austrian experience about time inconsistency of government finance through the printing press. And the specter of government finance through the printing press is always in the back of this kind of discussion. Now I have three issues that I want to discuss. First, what about the current situation? The second, what about multiple objectives? And the third, politics. What about the current crisis? I agree with Willem's assessment that there is something that the central banks can do, but we shouldn't overestimate their ability to do so. And I actually believe that it's dangerous if that ability is exaggerated. Obviously, the health issues are out of their turf anyway. In terms of economic issues, I think it's useful to compare today's situation with 2008. In 2008, it was the financial sector and it was a small number of large institutions. Now it's the real economy with very many, including very many small institutions. And much of the discussion about today's situation is actually, in my mind, driven by macro when the real problems are micro. It's not a question of aggregate demand or aggregate supply. It's a question of what do you do with a small service provider whose demand and sales are cut off, with a small firm whose ability to produce is stopped. Input availability is no longer given. Input costs rise. Payment processes are disturbed. This is not something you can actually handle in macro terms. And there are two challenges that arise. First, we need to get rid of the old distinction between illiquidity and insolvency. It's both, and the point is the solvency problems are extraneously imposed. Second, procedure. What infrastructure does the government have to deal with this, to address each one of, say, 150,000 small firms? We need to go through the banks. At that point, going by my own experience in a committee advising the government on issues with the real economy in 2008, I would expect moral hazard on the side of the banks vis-a-vis their small customers. How do we deal with that? Third point, the problem is a problem not just of lending. All of these programs that announce availability of loans miss the fact that there is an equity problem. That a small service provider who doesn't have any business today and has cost continuing is short of equity. We don't really know very much about how to deal with these things. That's one reason why I suspect that announcements can actually be harmful. because announcements can convey the message that these guys don't really understand what's going on. What we need is the combination of flexibility, expressing flexibility and determination, whatever it takes. That goes for central banks as fiscal authorities. Wholesale discussions about helicopter money, well, whether it comes from the government or it comes from the central bank, giving 1,000 euros or 2,000 euros to each person doesn't solve the problem of a small firm where things are falling apart. And it doesn't do anything to stop these firms going out of business. Earlier today, there was a comment that we can expect a fast recovery after the crisis is over. I'm much less convinced by that if we lose networking infrastructures at a very micro level in a great expanse. The final detail, and here I share Willem's concern. When the ECB says within our mandate, there are limits on how much they can buy for any one country. Within our mandate, does that mean they're going to abide by court judgments? If they say we're not going to abide by court judgments, what's that going to do to public debate? Second topic, mandates. Historically, the macro mandates that we're talking about have been latecomers. And central banks started out being banks with liabilities in terms of coverage of their currency and so on, which is one reason why in the Great Depression they didn't do very much. So talking about wider mandates is a luxury that comes from the fact that we have fiat money. Should we go for even wider objectives? I'm skeptical about that for reasons that have been amply discussed today. What about financial stability? The EU treaty doesn't mention it. In 2008, it was subsumed under price stability. If the financial sector collapses, we're going to have deflation, and that's incompatible with price stability. Is that approach appropriate? I see constellations where there can be conflicts. Think about the US in 1990, when a significant number of money center banks were on the brink of insolvency. And the economy was entering a recession. What did Greenspan do? He turned monetary policy around and said, damn the economy. I'm going to provide a very steep yield curve, allowing the banks to recapitalize over a few years, which happened, and Bush Sr. lost the election in the process. The credit crunch killed his election chances. The ECB in 2015 did the reverse, prioritized the macroeconomy and put pressure on the banks. By going into the long end of the market with QE, the ECB became a competitor to the banks and contributed to reducing their margins. Arguably, that has contributed to delaying the cleanup in the financial sector. Now, speaking as an academic, I must say we haven't done our homework here. We have no idea of how to deal with the trade-offs that are involved here. For example, would we argue that the risks of the Volcker turnaround in 79, that this turnaround posed to the financial sector, should have prevented him from moving ahead? Presumably not. At one point, I raised the question of how do we deal with this trade-off in a situation where both the economy and the banks are in bad shape at the governing board of the ESRB. And I got 4 answers. One was, obviously, the central bank must prioritize the macroeconomy. The second one, obviously, the central bank must prioritize financial stability. Third one, there is no conflict because if you don't repair the macroeconomy, the financial system will not get back into shape. The fourth one, there is no conflict because if you don't repair the financial system, the macroeconomy will not be sustainable. I was impressed by the spontaneity and diversity of the answers, which suggested to me that there is still a lot to think about. If I think about something like targeted long-term refinancing operations, the central banks makes the commercial banks do something. To what extent does that involve a Greenspan put? If things go wrong, we'll help you. Next topic, supervision, separation versus integration. My own personal preference is for separation for reasons that have been discussed this morning, and I don't want to go into that. I note that the shifts that occurred after 2008 were not based on the observation that integrated system had fared better in the crisis than separated system. But basically, it was a sense of the central banks that they liked to expand their turf. The key issue is transparency. And here I have a point about the Bundesbank. Separation of the 2 competences in Germany was stressed this morning. Actually, the work inside the banks is done by employees of the Bundesbank under the authority of the supervisor. But the Bundesbank bodies actually get to see their reports even before they're submitted to BaFin. So it's really a strange kind of symbiosis where BaFin and Bundesbank work together. When you put the 2 into one institution, there is an issue of corruption, both of supervisory decisions. Let's delay cleanups because we don't want to rock the boat for the macroeconomy. And for monetary policy, let's deviate from monetary policy objectives in order not to rock the boat for the financial system. There was a lot of discussion earlier on resolution. A key issue, and I fully agree with all the skepticism that has been raised. The key issue there is who provides liquidity and resolution. Nobody wants to talk about that because provision of liquidity and resolution involves fiscal risks, whoever provides it. And since we've all agreed that taxpayers will never be made to pay again, let's better not talk about that. This is why either there is no liquidity provision, as in the European regime, or there is a presumption that this is going to be done by central banks. Macro pro, quite frankly, I don't really know what that is. I see a hodgepodge of measures, some of them micro pro, some of them monetary policy, some of them fiscal policy. And the common thing that links them is that they are conditional upon some finding of financial stability problems or of macroeconomic problems with ambiguity about which. There we need to think much more about what is it that we're actually doing and how are we going to arrange them. Final topic, politics. In its Maastricht judgment, the German Constitutional Court ruled that all this was a was apolitical, was technical. It was experts doing something in the interest of price stability. And this was why, even though it was a significant transfer of sovereignty, it was still acceptable. The key point is, of course, it is political and has always been political. And by that, in contrast to Panikos this morning, I would say it's not just the financial stability supervision resolution part that's political. It's monetary policy itself. If you ask, why is criticism of the ECB so popular in Germany? It's because low interest rates do something to the standard of living of that part of the bourgeoisie that is in fixed interest securities, in fixed interest assets. And I suspect that the judges on the German Constitutional Court may belong to that very part of the German bourgeoisie. So there is enormous resentment from people who feel expropriated by these shifts. These people never complained in the 70s and 80s when the Bundesbank raised interest rates to extraordinarily high levels, adding 500,000 each time to the unemployed in 74, 82, and 93. But perhaps the Bundesbank was a class institution and had its political support also from that fact. That brings me to a point that was also raised this morning, which worries me a lot. The ECB has been, in terms of conditionality, has de facto been acting as an agent of the creditors. Panikos mentioned that, its participation in the Troika, its actions vis-a-vis Ireland, Greece, and Cyprus. And I consider that to be a problem. I was very sorry that the ECJ did not take up the Attorney General's, the Advocate General's criticism of that involvement in his OMT judgment. Institutionally here, we come across the fact that the independence of the ECB is stronger than that of the Bundesbank ever was, because it requires a unanimous act of all member states to revise it. With the Bundesbank, a simple change in the law would have sufficed. But I think that the ECB's getting involved in that kind of activity raises very strong questions about long-term sustainability, or alternatively, about submission to the courts of justice, which can lead to quandaries like the one I mentioned before about the limit to participation in bond purchases for any one member state. That's it.
Thank you very much. This was a very insightful and broad presentation covering a wide range of issues, which shows why this seminar, The Future of Central Banking, is both timely and necessary.